So this is, I believe, our fourth class. I'm going to share the first slide. It's going to be about the forum for March 4th. And if I can get us over there successfully, we'll be able to see what's up for next week. So we should be seeing the March 4th forum slide, give you a little bit of information about what that's about. And I'll give you about a minute, and then I'll close that and start on the slides that I have. Also, if there's a problem, I had my mouse freeze up yesterday and last week. So I restarted the computer. I'm hoping that everything works great. But if it did freeze up, I would just go to audio like I'm doing a radio show. And I have another laptop with the slides that if I had to switch to that, that would be great. Hopefully everything works fabulously. But we'll go from there. So March 4th, Kimberly Reed Edwards, the brave, magnificent women behind the Men of Sacramento's early motorcycle craze. I don't know what that means, but it sounds like it'd be a really interesting presentation this Friday. Okay, I'm going to move out of that one and come into our presentation for today. We're going into the second phase of portfolio construction. Now, so many things are happening in the world. I'll bring that thought and concern up to some point. Before the issues and problems with Russia, we had inflation at 7.5% potentially per year if that continued, but we had interest rates earning practically nothing, 0.05 with your money in the bank. So where do you go? You park your money in the bank, you get nothing on it. You actually lose buying power potentially if it continues at 7.5%. So by the end of the year, your 100,000's got a buying power of 92,500. So that's not an alternative. But then I turn around and invest in the market, and something like the Russia conflict occurs and the market hasn't crashed for us. It's down probably as of yesterday. Today we're down a lot, but we might come back. Yesterday, the overall market was probably down about 9 or 10%. Our hope is, and remember, before the market started falling, we want to get a portfolio constructed to meet your risk tolerance, meaning how far could it drop before you're severely uncomfortable at that point. And so we had discussed creating a portfolio that had a downside of about half of the market. That was just for educational purposes. So let's hope that if you had a 50 basis point, meaning a 0.5% beta in your historical volatility standard deviation was about half of the market, then we're never happy to be down. But if the market's down 10 and we might be down 5, well, at least we beat them on the way down. It feels a little bit better than for being down 4. And if the market was down 4, we wouldn't be happy. So we always compare each other with other things. We also talked about short-term, intermediate, long-term buckets or positions in your portfolio or separated. So when this does happen, if the market keeps falling, then you can let your old investments reinvest, maybe move one fund for another if you find a lower cost expense ratio good fund, but generally stay invested and reinvest, because you've got your short-term bucket established with CDs at the bank, money markets, ultra short-term bond funds. They don't earn anything. You could even pick a short-term treasury bond fund if you're a little worried, but you're not going to earn much. You're going to lose buying power, but that's okay because you can still see the greenbacks, so to speak. So I'm not going to try to talk anybody out of being safe and having cash that we know will lose buying power and try to get you into the market. You could lose twice as much if the market corrects for the short term and if you don't stay in the long term. So portfolio construction is extremely important. I do want to ask you to ask questions and stop me. I tend to speak very fast. I have a history of radio, and as you know, radio silence is deadly, so I get in the habit of talking quickly. But if I don't hear any questions, I'll assume you want me to move on. And we do have the pages listed here. We're on page 131 of the class workbook. And next week, if you want to just jot this down, we're going to be in class number 5, and we're going to start on page 156, and it'll go from 156 to 78 if you want to do your homework and jump ahead a little bit. So right now we're looking at portfolio construction. And as we look into the inner parts, the first thing I want to start with is, here's a portfolio that you've constructed. How do I start taking money out or putting money back in? Now, why would you take money out? Well, you already know the answer. Age 72, you have to, if it happens to be a big IRA, rollover IRA. You don't have to on a non-retirement plan, but you may decide to start taking money out. So we need to plan about how are we going to get money out of this portfolio. But then again, let's say you pulled money out of the portfolio, didn't have a big tax hit because it's a trust account, not an IRA. Maybe you pulled out some bond funds or other funds that haven't performed, pulled out a bunch of money and cashed it out and paid off your mortgage. Okay, now you've got an extra $1,000 a month with your mortgage payment that you don't have to make. How do we get back into the market? Okay, that's just a different plan. But please understand, no one person's situation is right for the next person and the next person. There's salespeople that want to sell you an investment product that it's like to a hammer, everything's a nail. But your situation is completely different than your partners or your neighbors or your kids, especially when it comes to comfort levels. Some people are extremely uncomfortable with the volatility of the market and the uncertainty surrounding Europe and Russia. The media has scared the heck out of us with some possibilities that could occur, but they've always been there. So my philosophy is, let's deal with what's here at home and what we can control and manage. Wouldn't recommend anybody get out of the market. It's still up considerably over the last 3 years. But if we have a properly balanced portfolio, we're not having to liquidate anything. And if we do, we pull it out of the short-term part of the portfolio. So where to invest your money up to and through retirement liquidations. Now, some of you have already done this and you already know. Some people call this income for life model, but let's say you want to reallocate, or you're not down very much. You want to get out of the market, but reallocate for liquidations. Maybe you don't have a government, city, county, state, federal government pension plan. So you've got to carefully plan out your large rollover portfolio for distributions. Well, here's some ways that people in the past have invested. It's just a thought. The first year's distribution, whatever amount that is, you hold back in your brokerage account in a cash account. You don't earn anything, but Uncle Schwab, Fidelity, Vanguard, whomever, TD Ameritrade, they hold your cash. You don't earn anything. They use it. They try to earn money off it, but you are guaranteed by that account not to lose money. You will lose money to inflation, but not actual dollars. So let's say you reallocate your existing portfolio or one of your portfolios for distributions in the future. I'm not considering taxes here. The IRA, of course, everything coming out would be taxable. Year one, you would put so much for cash. So let's say you need $20,000 for year one. That goes to the cash account. And then you have the money come out every single month, about $1,600 or so. Then years 2 and 3, right now, the next $40,000, you might invest in long-term CDs, money market funds. Well, I'm sorry, but you're not going to earn much. But the year 1, the year 2, the year 3 dollars that are in the pipeline ready to come out, that $60,000 is somewhat protected from downside markets, not from inflation, but downside markets. Year 3 through 5, the next 40 or 60,000. Then we look at maybe short-term bonds, floating rate. You can learn what that is. Look it up. Floating rate are lower credit rated government, or not government, but bank loans to builders and corporations. Short-term, high interest, low credit rating. Good or bad, that depends. High yielding fund. Those are junk bond funds. Now, junk bond funds in and of themselves can be very risky. They can rise and fall as much as the stock market, especially if people feel that these companies that I bought these junk bond funds are going to be in business next year. But if I have a large mutual fund, exchange traded mutual fund that has 500 or 1,000 high yield bonds, and they have managers that keep an eye on the issuers of these bonds so they can get rid of them if they get worried about it. I'm not going to guarantee that there's less risk, but I'm going to feel a lot better that somebody's got an eye on it. So the first year goes to cash. The next 2 to 3 years, I invest in long-term CDs, money markets. The next 3 to 5 years, I buy short-term floating rate, high yield, and short-term high yield bond funds. The reason for high yield now is that if the value of the bonds drop, I've got 3 to 5 years of high dividends reinvesting that might build me back to where I was or even better. So if you have a high dividend paying stock or bond or exchange traded mutual fund, put that in the intermediate to long-term bucket, because if it does drop immediately, you can leave it alone and give it time to reinvest and accumulate the dollars back. Years 5 to 7, intermediate term bond funds. We say intermediate, same reason. If they drop in value, they can reinvest. Now, intermediate term bond funds have and are down 2%. When the Fed announced that it was going to raise interest rates quite a lot, long-term treasury bonds and funds are down 7 to, I'd say, 12%. Yikes. Your short-term bond funds are probably down 0.25%, maybe 1.5%. That's not so great, but not very much. Your intermediate term funds are probably down 1 to 2.5%, not what you wanted, but you have plenty of time to reinvest the dividends, because we're not introducing the intermediate term bonds for 5 years. We're not going to touch them. So you've got plenty of time to reinvest. The short term, the ultra short term, and the intermediate term bond funds are also holding shorter term bonds that will mature. So the fund will hold them, get hopefully all the money, and then reinvest at higher rates. Any that they sell, they may take a loss on. So I would rather be in a bond fund that there's not a lot of turnover, unless the manager feels they need that to protect us. Dollars that we might need in year 7 to 10. That's another 20,000 a year, 60,000 equity income funds and total return funds. So those are exchange traded mutual funds. That's a basket of stocks and or bonds that can be bought and sold throughout the day. Now, the old mutual fund, as I mentioned before, you go to sell it, you put in the order in the afternoon, they're not going to sell it till the end of the day. Now, I had a client recently that got nervous about the market. She had an old growth fund that had a lot of technology stocks that were down 3% that day, let's say, the day before. We put in an order because she was panicking and said, look, I want to move out. She's not a managed client. She's an old legacy client that had a fund. And so, okay, I'll put in the order to this mutual fund to get you out. Well, the good news is by the time we put in the order and the fund had to cash her out at the end of the day, technology bounced back 3.5%. So she was in good shape, good timing. But had it not, she wouldn't have had the control of when to sell it. And had it been an exchange traded fund, and had I acted on her instructions, because she's not, I don't have discretionary management capabilities. Had I sold it and it was an exchange traded fund at the bottom of the market, she would not have seen that increase back to 3%, but it could be the reverse. So I'm not saying stay with a managed fund, it's better, or go with an exchange traded fund, it's better. They have their different characteristics. Year 7 to 10, equity income funds, those are a little bit more like blue chip stocks. The good thing is you can be reinvesting dividends over time. So if the market tanks and it takes 7 years to recover, at least you've had 7 years of 0.5%, 1%, 3% of dividends reinvesting at low prices. Right now, with all that's going on in the world, there are areas in Europe that a contrarian could invest in, and they may fall off the cliff. They may take off and go up when everything calms down. We don't know. If you're a contrarian investor, one that invests opposite of the crowd, you're running into risk and they're running away, and you may or may not be fortunate enough to have things turn out. Not that there's anything wrong with it, but it is risky. But the equity income funds, they have dividends versus the technology funds. Most of them don't have much dividends because they're piling the money back into the technology, or like Amazon, they're expanding. And if you're a young person, sure, I don't need my dividends for 5, 10, 15 years, and I'm just going to keep investing in Amazon, let's say. But if we're retired, we might not want to wait for those dividends. So we would look for companies that are in funds that own Verizon, AT&T, or Procter and Gamble, or so on. Companies that have already had their big day in the sun, calm down. Now they're trying to keep investors by way of paying a good dividend. Now be careful if a dividend fund has dividends far beyond what the market is. It's not free. They're either buying very depressed stocks that inversely the dividends are high. That's fine, but it may get worse. Or they could actually be borrowing money to pay dividends. So be careful. I would go with very reputable investment companies. The big name brands are quite good out there. The equity income funds, dividends, blue chips, not very exciting. They're not as growth oriented. Total return funds, those are funds that are similar, but the dividends might be a little bit less, but they're looking for funds that have the ability to grow in value and pay a decent dividend. Those are good for the middle of the road person. So a dividend exchange traded mutual fund, if you want dividends, a total return fund, one that pays a good dividend, not as high as the first one, but it has some growth involved. And then further out would be growth funds that don't care about dividends. They just want growth and taking over the world. And that's great, but it may not meet for this type of distribution plan. Year 10 through 15, that's a long, long time. Now we can look at funds that are stock related, like growth funds, and that could be more technology funds. The S&P 500 has what, 25–30% in technology funds. You're buying a growth fund if it's an S&P 500. As we've learned, I'd maybe buy 2 or 3 S&P 500 funds and get the cheapest management expense possible. Why 3? Why don't you just go to Vanguard and get it? Why Schwab and Fidelity and iShares? I don't know, maybe one company gets hacked. I don't want all my eggs in one basket. Plus, they're all fighting to get your money, so they've compressed the expense ratio for a broad market index fund. I've seen them as low as 0.015. That's like a free toaster going to a bank. They want you to go and use their investment, so maybe you use some of the other ones where the expense ratios might not be as low. Growth funds, because we're not looking for an immediate dividend, we're looking for future growth. And then international funds, today could be a very good day because they're down for obvious reasons. We have potential conflict in Europe. A lot of the international funds, just before these things were happening, you would see the analysts or people like me saying, it's time to start looking into international stocks. Here's how you can't totally take somebody in the moment. Just before this conflict with Russia began, I remember watching one of the big news stations, and their analysts were saying, oh my gosh, we're just way underweighted in international. Americans, you need to start selling your US stocks and buy international and get the allocations way up, probably like 25–30%. And that might be true at the time, but now with this conflict, there's big doubt in the international stocks and they're tanking in value, which a contrarian could say, okay, now I'm going to do it. But trust me, you can't trust anybody, even if they mean well, because something unusual happens the next day. I don't know how 100+ million investors, algorithms, computers, and robots are going to react to something that happens today. An announcement comes out and we might react favorable or negative. So the main point is diversify, diversify, diversify. But if we do our job right in diversifying, we'll never beat the market consistently on the way up because we're not fully invested in any one market. We're not having all our money in the total bond market index. That would be a mistake. They're too long term and now we're down in price. So maybe we have some in short-term bonds, but also the total stock market index, but maybe small, mid-cap, large utilities. So we want to be super diversified. And in year 10 to 15, all stock funds, growth funds, international, they might start looking good. I don't know where the bottom is. I don't know if things will get better or worse. Other categories, sectors, utilities, those people that did invest in energy are way up. Do you sell those now or do you hang on? I don't know. You have to look at the overall portfolio and let the numbers speak for themselves. What is the beta? What's the historical standard deviation and the Sharpe ratio? You can look those up in the book if you're interested. Rental real estate is always great. A little point about that. I had a client ask me, he's got some commercial properties, a lot of gain. He'd love to sell them, but he'd pay a huge amount of taxes. He's aware of a little thing called 1031 exchange, which means he can sell those properties and buy another rental, but his wife doesn't want to be involved. So he's almost willing to pay the taxes. He's being approached by brokers saying, no, 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 sell the properties and then have the money transferred into their giant limited partnership for 1031 exchanges. And you don't have to manage it. We will, and we'll just give you the income. The question or the problem there is there's a huge commission to the broker to get you into that big group of other investors, and you lose control of all of that. And we don't know what might happen in the future. So I recommended to him, he wants to get these properties to his 2 adult children, sell the commercial properties, buy 2 rentals, one by one child, one by the other, still in the investor's name. But when he dies, the kids will inherit it, no taxes. Okay. Let's go on to the next page here. This is a spend down plan, similar to what we talked about, but over time. If we're far away from when you might actually liquidate the funds, let's say you're a young investor in your 40s or 50s, you can have more money invested in aggressive growth stocks, small stocks, let's say. Or let's say you're putting money away for the grandkids, small company stocks, because they have more room to grow. But their volatility historically, in my opinion, is about 35%. Now, we haven't seen small company stocks drop like that recently, but they have a history of massive volatility if somebody questions the growth of the economy. You can also look at growth or mid to large company stocks. And the picture of the airplane is there because this is reminding us that we're extremely high up, maybe 30,000 feet or something. When we're up very high in a passenger jet, of course, we should wear a seatbelt, but if there's a lot of volatility, it's not comfortable, but it's not dangerous to the plane yet. If you're down here ready to land, meaning liquidate, we don't want to have high volatile stocks in the liquidation stage or the landing stage. So when we're up 30,000 feet, we can handle volatility. As we come down, let's say to the mid-level, we might be more balanced between stocks and bonds. When we get down closer to seeing the ground, we might have more bonds. And when we're ready to totally liquidate, we should have all the money in the cash. Now, this is not necessarily a retirement plan because you're never going to totally liquidate. You don't want to move everything to cash, probably balanced or something. But let's say this was a college education plan for the grandkids. So here the child is not born yet and you're in aggressive growth. And I keep missing this page. Sorry. So as you start coming into a landing to the child's education, then you start moving from aggressive down to growth and income, balance, down to bonds, and then down to cash. So that would, the top one would be the 0 age, and then the balanced might be age 12. And then we get to income and bond funds might be age 17, 18, because they're getting ready to start liquidating to pay for your tuition. And then when they're right in the middle of college, it's better to start moving money to the money market fund if they're definitely going to liquidate all these dollars for their education. Obviously, if they get a scholarship, it's a 529 plan, and you can take them off as the beneficiary and put their sibling on for the next person that might need it. Then you might go back to growth and income or something. But the point with this little chart is the farther away you are from landing, the more volatility you can have. So remember, the bottom of this chart would be like our short-term plan, and the middle part of the balance and growth and income could be intermediate type funds in our portfolio, and the top are the aggressive. In this case, we're coming in for landing for full liquidation. Most of you will never fully liquidate unless you're gifting money. And at that point, it's probably better to gift shares instead of cash, because your tax bracket might be higher than your beneficiary. Or the reverse could be true. Your kids are making a lot of money. You want to gift them something. You could gift them shares if it's not a retirement plan, but someday they could gift it to their kids and somebody's going to pay the tax down the road. But if you want to sell it, pay the tax and give your kids cash, you just did them a big favor. Okay, the opposite, buy-in plans, a lump sum into income producing fixed assets, interest reinvested into growth-oriented investments. Here's a benefit of a mutual fund company where you just put your money, let's say at a Vanguard money market fund, and then you decide, okay, I'm going to do their short-term bond fund. I need some yield, and I think interest rates are done going up for a while, and I don't think the values will drop. I don't know what you get in their short-term bond fund, probably 0.5% today, but in the old days, you might have gotten 2 or 3%. But in any case, whatever interest you earn on that safe account, you send that interest to one of their other mutual funds, the S&P 500 possibly, because you're only investing 0.5% a year. Or let's go back a few years. Let's say it's earning 3%. You just let the interest from the short-term treasury bond fund that you're not worried about, just let the interest go into another S&P 500 or other fund within the mutual fund family. Now, if you have an exchange traded fund, you can't do that so easily in a brokerage account. This is one benefit, that if you wanted to put everything into one little fund at Vanguard, Fidelity, or Schwab, or iShares, and invest it very cautiously so you don't have to be all scared about what's happening in the market, but just let its dividend income reinvest into the most aggressive investment, that's throwaway money. You're not going to think about 0.5%, or let's say you're earning 2%. Fine, as long as my principal is secure, I'm going to send my dividends out to do my bidding and give me some buys when the market's up and the down. That's one of the most conservative ways if you want to be invested. The second is a lump sum into income producing fixed assets, like a short-term bond fund, with earnings plus part of the principal reinvested. So right now, if you're only earning 0.5% in a short-term bond fund, you might instruct them to reinvest the 0.5% into the fund, don't do anything with it, but take 1% divided by 12 months, 1/12 of 1% each month, and invest that into the stock market. Now, you could invest a lot more, but at least you've got your nest egg secure, and you're slowly drawing that down over time into whatever stock market sector or index fund that you want. I'm just saying, it's not the most efficient. You will not have made the most money in the long term, but you can live with yourself and you don't have to panic. Or this could just be one account you're doing this with and everything else is invested completely differently. The third little highlighted area is the lump sum with 50% invested in a fixed account. What's a fixed account? Cash and bonds. Today, we want short-term bonds, but someday we'll want intermediate to long-term bonds. But half of it's in a fixed account with less, not no volatility, but less, we hope, less volatility. And that stabilizes the portfolio because the other half is in growth-oriented stocks. So bonds anymore are not great investments. They're great reserves, they're great savings vehicles, and they're great buying opportunities if you need to move them into the market when it falls, or if the market dropped considerably and you wouldn't consider selling the stocks, you go back to your bonds. Hopefully they're short-term bonds, cash, CDs, and money market funds. But hence the dilemma is if you have short-term bonds because you don't want share price volatility, you're going to get almost no yield. You could get lower credit rated short-term bonds and get the yield up, but then there's question on what's the share price going to do if people get scared and believe that there may be some defaults. So you can get there with a yield, but it's not without strings attached. So we need to balance things out. Like I say, high yield bond funds, junk bond funds are not down very much when interest rates go up because they already earn a huge dividend. But if people believe that those bonds aren't going to be paid back, Katie barred the door, those things will drop just like stocks. Therefore, if you want a junk bond fund, one, I'd rather have a short-term junk bond fund with a manager who has hundreds or thousands of junk bonds in there. So when some go in default, and they will, it has less effect with us. And they're so well diversified that if the market tanks, even in that fund share price, I can keep reinvesting and just back off from liquidation. Last one, a lump sum into a diversified asset allocation model. So each of these get a little bit more aggressive. The first one was all cash or some super safe place and just reinvest the dividends. The other one is all cash, reinvest the dividends, but pull out 1, 2, 3, 4, 5% divided by 12 each year. Or the next one is, okay, lump sum half into cash and bonds, half into stocks, and just let things reinvest. What I'll do for my clients is the bonds will go send their dividends to cash, and then we'll reinvest into the stock related funds that need an upkeep. They need healing. We need to add money to a fund that we have a lot of faith in, but it's down. Let's say an international fund. It's a great fund, but now it's down, whatever. We might take the dividends from the bonds that are accumulating and go feed that international fund that is a high quality, low cost, well diversified, but help it out by buying more shares while things are down. That's the other thing to keep in mind. If you want to invest for income, but you don't want to worry about it, you need to stay on the conservative side and just let things happen and draw your money as you do from those buckets we talked about, the cash and then the short term and funds like that. And then you don't have to worry about where the market goes. But if you're an investor and the market tanks on you, that is not necessarily a bad event if those dollars are going to be invested longer term. You have some for short-term intermediate, but the long-term positions, when the market falls, this is the time to start moving money over from the short-term positions that were earning nothing. They're your troops. They need to be moved into the long-term positions if you have some that have dropped a lot. But even though the market's down today, it's nothing compared to March of 2020, right? Or 2008. We saw the S&P drop. I think it was in March of 2009. It was down to 65% decline, 65. Then it bounced back up to a 50% decline, and it took 5 years or so to recover. Now, fortunately, if you have a properly balanced portfolio, we might have held the S&P 500 total return, which is not all techs. It would have spread out the allocation. But that total return would not be a hero last year. Look at me, we're up 26%. It might have only been up 12 because it didn't hold just Amazon, Netflix, Google, and that. It spread everything across the board. That's the beauty of these new exchange traded mutual funds. You can find somebody that will create one very similar to what you're comfortable with. I don't want to own all of the S&P 500. It's just up too much and it's got too much tech. Fine. There is a total market S&P 500 that'll do, like I mentioned, spread things out. And you're not as risky. You get a little bit higher dividend. You don't get the upside, but the downside we hope would be less. So these are ways to buy in. Let's construct the portfolio. I'm loving my mouse works. I'm going to have to buy a new computer today. Internal securities among funds, among typical, among typical different funds, typically different funds. So the point here is that we want to look at 3 levels of diversification. When we create this Charles Schwab, this Fidelity, this Vanguard, this, I don't know, TD Ameritrade, and all these other brokerage account. And the reason we like a brokerage account is that we can buy from any different investment company we choose. So you can have a TD Ameritrade account and you can buy Fidelity funds, you can buy Vanguard. If they're Vanguard mutual funds, they'll probably charge you a few dollars because Vanguard's not paying them a fee to be on the platform. That's a whole nother soap opera. But if you're in a brokerage account for all of your money or 2 different brokerage accounts, 3 different, whatever the case may be, the cool thing is the brokerage account allows you to have funds from, I'm just going to name iShares, Wisdom Tree, Fidelity, Schwab, Vanguard, so on. So you don't have to be stuck with one company. So I encourage people to take 10 to 15 different funds. Half of those half as many should be from different companies. So I shouldn't see all Vanguard. What if they get hacked or something happens? They shouldn't be all Schwab or Fidelity or iShares. I like to spread them out among the different companies. And we talked about the pyramid concept we'll talk about later. But among these different companies that are in there, we want many different types of fund. If we have a large company stock fund, maybe a small percentage in small caps just to offset the balance. If we have so much in equities, meaning stock related funds, obviously we want some fixed assets relating to bonds and cash, but that's a whole nother soap opera. We're not getting high yield, so we're just parking money right now. Among all those 10 to 15 funds, you're going to have thousands, in my opinion, 3 to 5 or 6,000 stocks among all of the funds mixed in the portfolio, and even more, 5 to 20,000 bonds. So we've got super diversification. And again, if I do my job right, if you do your job right, in being diversified, we're never going to beat whatever index consistently on the way up. That's silly. I would have to own everything that the S&P owns to try to beat it. And I can't beat it. If I own the same things, I'll do exactly the same. Or I could borrow money, leverage, and buy more of it. So when it goes up, I made more money. But leveraging and borrowing money with securities is not a good idea, and I wouldn't recommend it. So you want to be careful with that. You could buy one area, a sector. I don't know, say utilities are still down 6%, and you bought utilities and the S&P went down and utilities went up. But that's a short-term aberration that occurs. So our main thing is diversify among companies, among funds, among internal securities, and then whether you do more aggressive or less aggressive comes out when you start to select the funds and you create the portfolio. You can create the portfolio and look at your Morningstar report and see, am I too far off into the woods in my risk level or not? Before I go on, and my mouse still works, any questions for me?
Hey, Bill, it's Marcia.
Yes.
And what if the mouse isn't working, you could try just using your down area. Arrow,
oh, good.
The down area arrow to see if it goes down to the next one.
It works perfectly now, but you young kids, you know all this stuff. So I'll keep that in mind. Thanks for telling me. She knows so much about technology. Great idea. Thank you, Marcia. I will do that, and things are working, but I will definitely do that. So let's go into the next slide. But anybody have any questions? I mean, nothing happening in the world. What would we be talking about, right? There are scary times. I've seen several times in my career. You've seen them in your lifetime. And what we have to go back on is, did I manage things properly to this point? Fortunately, our market's not collapsing. We're having a little bit of a correction. And if we're not heavily in growth related stocks, we're probably good. Although today, as you'll see, value and blue chips are down more than growth. So that's why we want to see you create your portfolio or portfolios in the balance that you have faith to keep going forward into the future, and try not to watch the news as much, maybe every other day instead of every day, because we have to understand that the news media, they have to hype everything up much farther than what it really is to get our attention. And if they don't get the clicks and the advertisement and things. So step back and maybe watch it at the end of the day, every other day, and stay on your original plan. Okay, some of the concepts we talked about before. If you've got a portfolio that's fully invested, say it's a rollover IRA from an old 401k plan, that's fine. Little tidbits: if you got sued, if it's a rollover, not a contributory IRA, but a rollover, okay, so you don't want to combine your old little IRAs to the big rollover IRA. We want to keep the asset protection in case you got sued. Your rollover IRA should have the ERISA protections, Employee Retirement Insurance Act. So you got a rollover IRA, ton of money there. You combine your 403B and your deferred comp and your 401k, whatever. They're all retirement plans. You got a big bucket there. Here's the concept that we talked about before of short-term, intermediate, long-term. This is our lateral integration plan. Now, they don't have to be equally balanced. They're not 33% in each little bucket. They can be any percentage you choose. But for the money that we want to have for 0 to 5 years, or what we call short term, this is similar to our first slide. You might have CDs, treasury bills, bank savings, or ultra short-term bond funds. Now you can get ultra short-term treasury bond funds if you have a brokerage account, or you could buy CDs. A little warning. If you buy a CD that's like a 1-year CD, whatever it pays in interest, if rates go up after you bought it, and you sell it, you could get less than what you invested because the buyer has to hold that CD at a lower rate. So in a brokerage account, CDs act just like bonds. At the bank, they might not, because the bank doesn't want to lose you as a customer. So they might let you cash out with no interest and not lose principal. Be careful. Same with T-bills. Treasury bills are like, what, a year long, and then treasury notes are 10 and treasury bonds are 30. They're all guaranteed by the government, but if you sell them early, they don't have to buy them back, an investor does. But generally speaking, these things here, the ultra short-term positions, are what you want in stage 1, the short-term allocation in our lateral integration plan. Could be held at the bank or in your brokerage account, whatever. And you can buy CDs in a brokerage account. Just don't sell them early if interest rates go up, or you're going to possibly lose principal. Stage 2, any percentage, but in the stage 2, we're looking at more bond funds. In today's world, it would be short-term, maybe intermediate if you think interest rates aren't going up anymore. Balance funds. The difficulty I've had with balance funds is, I did it again. The balance funds is that the bond balance fund usually will have intermediate to long-term bonds in it. So I've gotten clients out of those recently, and then you create your own short-term bond fund over here, equity dividend paying stock fund over there, and get out of the balance fund altogether. There's very few balance funds that, although they might have a third or a half in bonds, they're long-term bonds. What's that all about? And then the other half are stocks. And you know, we're pretty tolerant of the stock market going up and down, most people, but we're not with bond funds. What the heck? So we should be in cash, maybe ultra short-term, maybe short-term bond funds. If you think the Fed's done raising interest rates, I've seen people rush out by long-term treasuries and make money, but I don't gamble with these kind of things. And the long-term treasuries are probably up today. If people get scared, they want treasuries. So the second stage, bond funds, balance funds, etc. Something that has less volatility. Maybe preferred stocks. I have some exchange traded preferred stock funds that would normally be very interest sensitive, but they're adjustable rates, so they're about half as sensitive. So there's a variety of things out there you can look at. But again, I would recommend the brokerage account at one of the big brokerage houses that you, or if you have an advisor, the advisor has minimal discretionary capability of reallocating. They can't take money out for themselves. But diversify as much as possible among the companies and the funds. Stage 3, this is where you're going to go for 10 years and beyond. If you live too long, then we have money growing, because remember, in the short term, we love the guarantee of these short-term things, but we get clobbered with inflation. In the long term, we love the inflation growth because we're buying stocks of companies that are raising prices and pass along that maintenance or even gain to inflation to us as shareholders. But we don't like them short term because if people get scared, they sell them and prices drop. So short-term money, we mentioned long-term money should be in equities, real estate business, and collectibles, because in the long term, they represent keeping up with inflation. And I can't believe I'm talking about this because I started in 1980 when inflation was extremely high. And then as it worked its way down, we haven't worried about it for 40 years. And now it's like, oh my gosh, what are we going to do? There are a lot of new exchange traded mutual funds that are designed to keep up with inflation. The only problem is it might be a little late to the party. I'm just saying. The people that create these exchange traded funds do so because they want you to invest as much money into their allocated plan. They're usually fully disclosed, full transparent. Expense ratios are reasonable to good. I've seen some that are horrible. So they're not doing anything wrong. but they want to raise 100 million, 300 million, a billion, because if they're getting paid 0.25% on $1 billion, that's a lot of money. Now, if they get up to $1 billion, the expense ratio will start going down. But they're going to create new exchange traded mutual funds to tickle your fancy and tell you, hey, this one's going to keep up with inflation. It buys, all these natural resources and all these, maybe they have access to Bitcoin and gold and all that. That's fine, but it's better to buy those things when they're not popular and they're just dead in the water, because right now those areas could be overpriced, and I would hate to see people buy things ahead of time. Short-term, intermediate, long-term, one portfolio or 3 different portfolios if you prefer. Stage 1 must provide instant cash. As we know, stage 2 is designed for intermediate term savings periods. So give yourself 0 to 3 years in stage 1, maybe 3 to 5 in stage 2, and then 5 or 10 years and beyond in stage 3. These are not locked in requirements, just mental thoughts. I'm going to park these over here. They're not going to earn anything. They're going to lose to inflation, but at least my short-term treasury fund, it's there. And over here, my long-term stock funds that with Schwab, Fidelity, Vanguard, all these top-rated companies, if it's an index fund, super low cost, it just tanked. I'm going to move some money over and help it, right? If your kids bring home a horse and you agree to keep it, are you not going to feed the horse when it gets skinny? We need to have this plan. Or 10 years from now at 7% inflation, your cost of living could double. And that's not including healthcare and all of that. So for your long-term insurance, so to speak, equities and stocks are absolutely needed. Keep your house, move into care, rent it out if you think the price is going to keep moving up. So we have all these things. So these are just mental notes. They're not requirements. Short-term, intermediate, long-term mental positions, so you can leave something alone if it drops a lot. Some examples. Stage 1, U.S. government securities, money market funds, insured certificates. We mentioned that. Short-term, intermediate, long-term, could be long-term bonds. This is for the very conservative investor. You could be buying intermediate to long-term government bond exchange traded mutual funds, and they're down in price. Go for it. I don't know that rates will go up extremely high. Maybe it is time to buy long-term treasuries. I'm just saying, if this is for grandma, short-term, intermediate, long-term, they're all government-backed, government money market funds, short to intermediate term government bonds, maybe some long-term government bonds, or go with a mutual fund company, put money here and here, but slowly have money buying into the long-term bonds. Have I lost you so far? Come on, this is a cooking show. New ways to do things. It could be a good time to be buying into long-term treasuries. Who knows? That's the point. If everybody knew what was going to happen, or if one person knew what was going to happen tomorrow, would they share that information? I don't remember Bill Gates calling me or anybody else telling me, has he got a plan? He keeps it to himself. So we need to plan what works for you. So this is for grandma. She's freaking out, really worried and scared. If we have the short-term, intermediate term government bonds, we know that we're going to get our money back. The long-term, we just hang on. Conservative growth investor, money market funds for the short-term, adjustable rate government securities fund. There's only 2 and they have high expense ratios. That means they own government mortgages that can adjust up if interest rates go up. Neither fund has turned out to be great, but the concept's good. Short-term government securities. Did I get this right? No, that's the very conservative. Okay, I'm not going to touch my cursor. So the money market funds, adjustable rates, and so on. Stage 2, short-term, intermediate, but also income producing and utility and preferred stocks funds. Balance funds. Stage 3, private business, personal residence, a variety of growth oriented. So this is a conservative growth investor. We have the short-term, the intermediate, and the long-term is moved up to not just mutual funds, but private business, personal residence, and a variety of growth mutual funds, preferably exchange traded mutual funds. Aggressive investor. They're not worried so much about stage one, but they might have adjustable government securities. They might have floating rate, low credit rated junk bonds. They might have short-term high yield junk bonds, and they might have index funds and a variety of ETFs. Volatility is not as much of a concern to them, but they still want to have some money on the side so they can move into stage three. Stage two, growth-oriented mutual funds and index funds and exchange-traded funds. That's obvious. That would be more technology today. There's a lot of different areas. There's the new Bitcoin is coming out, the blockchain technologies, the cybersecurity technology, the self-driving cars. There's tons of areas one could choose from there. Then in stage three, and again, stage one is immediate liquidity. Stage two is, I might pull it out within the next couple of years. Stage three is, I'm not going to let myself pull this out if I panic. Okay. Aggressive growth oriented mutual funds, index funds, ETFs. Okay. They could be down right now. An aggressive growth fund might be down 15%. Individual stocks, I wouldn't recommend it, but if you have one you love, okay, an individual stock, super duper volatility, but if it doesn't do what you want and it drops, you might choose to reinvest or sell it at a loss. Rental real estate, long term. There's pros and cons depending on where you are. We could spend days talking about that, but it is a good long-term investment, not necessarily for people to go buy at the top of the market, but there may be places in the United States where the prices are still good. Limited partnerships, if you can find a legitimate one where the investors looked at and taken care of, and the general partner is not there just to take care of themselves. Maybe it's a family limited partnership. Okay, that's great. Just be careful. Again, these 1031 limited partnerships, there's real strings attached. They could help you in the short term, but you might regret them in the long term. Private business, obviously, you're going to make the most, but you can lose the most. What do they say? 9 out of 10 businesses don't make it. And collectibles. So again, short term, no matter how volatile you are, you could have an aggressive growth exchange traded fund be in stage one, as long as you can cash your money out. But most of us don't want a lot of loss if we go and have an emergency and have to liquidate money. So short term is 0 to 2 years. Intermediate term, stage two might be 2 to 5 and 5 or 10 and on. So those are some of the main considerations to do. I still have use of my mouse, so I'm going to see if I can move Morningstar over here. Hey, this is not what I like to look at every day. Psychologically, emotionally, I would rather see all these things be green. But then again, if they're all green and growing, if I'm not fully invested, I'm going to be paying higher prices into the future. Or maybe I step back and wait till I see more red. So what do these little boxes mean? They're very small. Don't worry if you can't see them, but Morningstar gives me these little boxes and they update. So it just updated. The first column tells me what value stocks look like. Small cap companies, mid-size and large cap. They're all down considerably. Market's down like 700 points. The blend between growth and value is also down, small, medium, large. They're down a lot. The more growth-oriented companies are down less, and I would assume that's technology. So technology is having a better day than the blue chips and all these other stocks. And I can't tell you why they're down. It could be people are moving out, waiting for things to get worse. They want to move back in. Why has the market kept moving up in the last several months or years? One thing very basic is it's not like you can rush over to the bank and get a 5% CD and wait out the market and say, I don't want that kind of risk. The yields at the banks are almost nothing. So there's not many areas to look at but the stock market. Older investors, or if you had bond funds you've already bought years ago, you might choose to keep those. But one reason that the market hasn't corrected so much in the past was there was nowhere to go. That's unfortunate. When the Fed did announce that they were going to raise interest rates December of 2018, and more recently, you saw the market start to correct. And they're hoping to raise interest rates more in the future. But then again, given what's happening globally, can they? Well, it's thought that maybe they can't raise interest rates more than 0.25% once a quarter, but then does inflation keep going up? So they're between a rock and a hard place. but you've got your short-term, your intermediate, your long-term position. So if your long-term positions tank big time, they're good quality funds and you're diversified, you're just going to hold on to them because we don't really want to read their report card for 10 years. Yes, we do want to make sure we have good funds and that, but we're not really expecting those funds to be needed for 10 years. And that's for late term inflation. The world's going to be a different place in 10 years. Okay, so let's take a look at the portfolios themselves. We'll do a model portfolio again. We looked at it a little bit last week. Let's say a growth fund, growth portfolio. Very small print, but these are a listing of funds here. Here's one that is in the growth portfolio, but it's really meant to give it some basis. This is Cohen & Steers preferred stock and securities and income. And it's an institutional class share, so you can't get that. But even that has a cost of 0.85. That's way up there. But why would somebody buy this? Well, possibly because it's in the top 5 stars out of 5 for the last 10 years. It's a silver rated out of gold, silver, bronze by Morningstar. Its yield, you've been earning 5%. Okay, I don't know that you want to buy it now. It's dropped in value a bit recently, but it's gained much more value than its index. So you're not giving up quite as much. And if we look at what it's done recently, year to date, it's down 4.79. Well, preferred stocks are kind of like bonds, kind of like stocks. 30-year treasuries are down, I'm guessing 9 to 10%. So they're only down 4.79. And its index down here, the index word, if you can see that, the index is down like 6.05 and we're only down 4.79. So to be down 1.5%, let's say less, is significant. So one might decide to use this fund. I'm not endorsing any specific fund, but for information only and for education, interesting that they have good performance. And if you have good performance and a high silver rating, if it's a managed fund, it's very possible that they can charge you a higher rate. Also, this fund buys derivatives to try to protect the investors on the way down. So maybe that's part of the expense ratio as well. But you will have seen that the performance is quite a bit better than its index. Here's a fixed income fund through Fidelity. The other one was Cohen & Steers, Fidelity Advisors, 4 stars. It's a gold rating. Gold is a grade that Morningstar gives to the funds that are out there. And not all funds get rated. They just don't have the time to do it. So some of them are rated by an algorithm, but this one's rated by the actual analyst. So this is a strategic income fund. Well, what does that mean? Well, it probably means that they own bonds strategically. What does that mean? Corporate, maybe some governments, a variety of things. They, one, outperformed their index, whatever index they're comparing, similar to them considerably. They are down, but they're down. They have still a greater gain than its category or the index. So one could say, okay, I'm impressed. But year to date, they're down 3.35, but that's pretty good compared to 6% or 9% of longer term bonds. I'm going to go up and just look real quick and see what the yield is here. Yeah, 2.83, 2.5%. That's pretty good, but you're going to lose some of that if you sold it because they're down 3.35. But if you're not planning to sell this fund and you're earning 2.5 plus, and it hasn't dropped all that much recently, the longer term bonds got hurt real bad. It's kind of survivable. It's a good yield. I'm not going to sell it. And yeah, I don't like it dropping in price, but when I'm reinvesting dividends, I'm getting them new shares at a little bit cheaper price. The standard deviation or historical volatility is 6.95, where the index is less, 3.72. So it's going to have a little more volatility. It dropped in March of 2020 by 9%. But again, if we're not selling, we're going to be reinvesting the dividends at lower share prices. Here's the number that's important when you're looking at bonds. And I know from experience, this fund is made up of bonds, mostly 86% bonds, a little bit of 6% cash. duration. Anybody remember what that is? That tells us that mathematically, and it's not always proven out, if interest rates are planned to go up, Fed says we're going to raise interest rates 1 full percent like they did. And some thought they're going to raise them 1.5%, 2% over the next year or so. This fund, by way of its duration, should have dropped 4.51, but we saw that it only dropped 3.5 or 3.6. I'm going to give them credit that the managers did such a good, wonderful job that they helped us not fall as far as they could have. Now, how on earth are you getting 2.5, 2.6, 2.75 yield? Are these AAA rated T-bills? Wait a minute. Long-term T-bills are barely paying what, over 2 or something. No, these are double B rated. So they're not AAA, AA. They're not triple B, they're double B, meaning they're working their way down into the quicksand, more risk. But it is a managed fund where managers work on trying to reduce the risk. Now, I'm not guaranteeing that they can, but they have saved us the 1% on the way down. Because if the Fed announced a 1% over the next year increase, this fund should have dropped by 4.5. So that's one thing to be somewhat encouraged with and somewhat impressed with. Let's see what the expense ratio is. 0.61, that's fairly high, kind of a high expense ratio. But we're getting something in return. We didn't drop as far as the index dropped. So maybe the management is pretty good. Maybe this is why Morningstar likes them. We could spend all day talking about that. There's two different companies. Let's go to another one. Here's an iShares defensive high yield bond fund. Well, we don't have time to read into it, but high yield it tells us that those are junk bonds, 4 out of 5 category for the last 10 years. And it's a silver rating. The Q stands for quantitative, if you can see that. But look at the yield, 5.32. So look, there's no free lunch. We know that. I'm sure when we go down and look at the credit rating of the bonds in this portfolio, they're probably single B, maybe double B at best. We have a fund that is managed, so therefore the expense ratio is 0.35, not 0.035. You could find a high yield fund that is an index fund, and it should have like 2,000 bonds on it. That would be okay. But I still would rather have managers protect us, not literally, but help us avoid losses. They can worry about which bonds might go in default and they can sell it or buy another one. I don't have to worry about that. The managers worry about that for me. This is iShares, and they have a plan that they will try to reduce the risk on the downside. I'm sure they have some defensive measures. You can see that they've outperformed their category in the yellow, the index in the red, and they're in the blue. And they are down 3.36%, which is not bad going forward if they're earning 5%. But we don't know. If people get really scared after a day of craziness, they could drop more. Morningstar gives them an average rating for risk and a better than average on return. Their standard deviation is 8.5 and the index is 9.2. So they've done a good job of keeping the risk down a little bit. Worst case scenario in March of 2020 with a pandemic, they were down 11.12. Now this is where we get to see. This is a bond fund, but they are junk bond funds, lower credit rated. You would only worry about those if the economy started tanking, or at the time COVID hit, oh my gosh, companies are going to go out of business and not pay their investors back for the junk bonds that they issued. That's a panic time. But when that happened, this fund dropped 1% less than everybody else. They had managers to try to get you in and out of better quality bonds if they could. They couldn't avoid the downturn all together. And oh, by the way, if you buy individual bonds, there is no bond market like a stock market exchange. So you better know somebody who will buy the bonds from you. Now you could go to Uncle Schwab or Fidelity or Vanguard and tell them to sell your bonds, but they've got to go find the buyer, the individual buyer, through their network. It's not like stocks where they're listed and you can see who's there. You could, in fact, though, own bonds of all high grade, low grade, and an exchange traded mutual fund and have liquidity. You can sell that basket probably fairly easily, whereas one bond might not be able to be sold at all. So there's technically a little more, or maybe a lot more, volatility in an exchange traded fund versus one bond. Questions so far? Okay, I knew it. Double B rating. This may be too low for some of you that don't want to take the risk, but that strategic income fund through Fidelity had a double B rating. So it only earned, I can't remember, high twos or so. And if you said, well, I like this fund because it earns 5, I don't care about the other fund. Well, here's why. This one is lower credit rating. It has more dangers in a complete economic collapse, but then don't we all? What good is having a guaranteed CD if they shut down the banking institutions? We're in good shape. We're a lot healthier, and there's a lot of good signs in our economy, but it is a scary times. Single B rated, that's why the yield is so high. And we definitely want managers keeping an eye on this. This is kind of like if I'm going to have pets, I don't know why, but if somebody wanted to have rattlesnakes in a cage, I'd rather have a snake wrangler manage them than me, right? So high yield bonds, if they're down very much today, some people would say that's a good time to buy. Some would say stay away altogether. And I have a short-term memory, 3.36 year to date, but 3 years, they're still up 5.95, even after taking that away. So if you don't get squeamish with the share price fluctuation and you're super well diversified and have a good bond manager, they might not be too bad as a part of the portfolio. Let's pick another company, Schwab, just so we see. Every single fund I'm bringing up now is totally different from each other. So we shouldn't say, well, I like that other one because it had better performance or lower cost or better yield. They're all different. You have to compare whatever funds you're looking at with the exact apples to apples. US dividend equity, meaning bigger company stocks, and they're looking for ones that have good dividends. And then good is relative. A fund with a super duper high yield doesn't mean it's a good stock or a good fund. It means it just pays a high yield, maybe in exchange for share price appreciation of the stocks in the fund. But here it averages about 3%, even if you buy today. Based on this particular report, you want to confirm it with the company. If you look at the chart, Schwab put this together. I think they probably created their own index of income producing stocks, but whatever they've done, they've outperformed whatever index in the red that they're tracking and the category in the yellow. But of course, like everyone, they're down. But over 10 years, if you invested 10,000, you don't have 30, you have 39,750. So sounds like this is a good long-term position, but in the short term, wow, they're only down 4.61, whereas the growth stocks could be down as much as, on average, 15%. I don't know what the S&P, as of yesterday, say it was down 9 or so. This fund's down half as much. Now, it doesn't make it a better fund than the S&P. It just means it's in the right place at the right time than the S&P. S&P is more for long-term positions. This fund is for, look, I don't have time to wait. I need a dividend. I need stability, and I need some inflation growth. So it's down half as much as the market. But in the long term, it probably grows half as much. Let's see if the positions in this fund are Coca-Cola, Verizon, Amgen, Merck, Pepsi-Cola, Broadcom, Cisco, IBM, Pfizer, Texas. They got 101 positions, all over the hill stocks, good stocks to own, but I mean, they're not the up and comers that are just going to knock our socks off. They're there. They're good quality, large company stocks. And in this case, we're trusting Schwab to put together a group of these stocks for us. They represent consumer defensive, communications, healthcare, technology, and so on, 101 different stocks. So you might have said, I don't want the S&P because I want more predictability and I want a high dividend. You know, if you buy the S&P today and it's down 9 and it bounces back and takes off, you'll be very happy. But what if we enter a long-term recession? Here, at least, we're getting, what did we say, 3%, 3+, and we can either use that to our advantage and reinvest it into this fund itself, or you could pay to cash and then reinvest those to tech stocks. There's so many different recipes that you could work with. And people in my business tend to come up with their own little plans and recipes and allocations, act like that's going to save the world and this is where you should be. Everybody has a different allocation level. If I'm a big company, then I just ask you, are you conservative, moderate, aggressive? What's that mean? Well, you could take this much risk. Okay, fine. Go away. Don't bother me. I'm the advisor, let's say. And I put you in the same portfolio that everybody else has with the same liquidity, time frame, and volatility comfort levels. And then they charge a fee and then they let the computer manage it from then on out. It's like a computerized dating service that you have to go with what they tell you to do, right? The personalized approach is to create a portfolio following some of the basic structures that we have in your workbook, and then making sure that it fits your liquidity needs, short-term, intermediate, long-term, but also your risk tolerance, or how comfortable are you with volatility. Because if you want the most return, you're going to say, look, put me in a 1.0 beta. That means as risky as the market. But if you're not, maybe you want to go to a 0.50 beta and have a historical volatility of half of the market, or less beta. But we have to be realistic. We're giving up some gains. Let me go back to Schwab just real quick. Five stars. Silver rating. One of the things that helps these funds that are a buy and hold, and they don't use the word index, but it's similar to that, is they don't have a lot of trading. I wouldn't expect buy, sell, and they don't show it that I'm seeing it, but 0.06. Well, this is, and everybody has one. Vanguard has one just like it, and other companies. But this is a good category of fund because you can get those well-known stocks, super high dividends, 3%. I mean, come on, that's pretty high. Expense ratio 0.06. So if you just say, to heck with you, Bill, I don't want you to manage my money. I don't believe in people managing my money. I'm going to do a brokerage account and I'm going to buy this fund. Well, buy one from Schwab, buy one from Fidelity, iShares, Vanguard, Wisdom Tree, and get several of them just so you don't have all your eggs in one basket. And then you have diversification geographically among companies. Those funds will be in your brokerage account, but that's just holding the data. The money is spread out all over the place. Just saying. We go down here to T. Rowe Price. The reason that I might put T. Rowe Price, their S&P 500 fund, in here, you might have to pay $5 or $10 to buy it because let's say Schwab or Fidelity or somebody else that doesn't like T. Rowe and you want T. Rowe, they might charge you $5, $10 to buy it. It's a fund. They don't get the spread on an exchange traded fund. You can buy T. Rowe Price exchange traded funds probably with no cost because they get part of the spread. But this is a mutual fund. If you went to one of these other companies and bought it, expect to pay $5 or $10, no problem. If I want to buy the S&P 500 and I don't want all my eggs with Vanguard, Fidelity, Schwab, I need a new player in here. I just have this so we have a different company, just so we don't have all our eggs in one basket. And here, this is unusual because not all of their funds are this cheap, but it's 0.05. That's pretty darn low. You have to have 500 million and it's an institutional share, so you personally couldn't get it. I could get it, or advisors can get it because we're grouped together. There's $30 billion there. I'm just saying, for reasons I don't know, I don't like all my money with one company. Here's a company and a fund within this portfolio that is made up of utilities. Now, SPDR is, we've named that Spider. So you'll see their advertisement. They show the pie chart and Spider's sector funds. All a sector is part of the overall market. So one sector is utilities, another one is energy, another one is communication, another one is real estate, and all the different sectors that, technology and all that stuff. This is one sector of the overall market that one might consider. If you saw that thing just fade away, it's okay if you're drinking a glass of wine. It's really happening. That's what I have to put up with. Utilities. So we know this is a fund that owns nothing but utilities. I use the SPDR, State Street, I can't remember the name, blah, 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 investment company, and they issue sector funds. Its expense ratio is 0.10. 0.10, that's fine because they're actually having to go out and get the stocks and follow the index. Their yield is 3%. Okay, the 12-month yield is 2.9. Well, what does that mean? If I buy the shares today, according to the SEC yield, because the price of the shares are down 5%, the same dividend with a higher price share earned 2.94, but because my share price dropped, but my dividend dropped, hey, I get a higher yield than you do because I bought them after they dropped. It's kind of cool. It's all relative. 1.0, different company, 4 out of 5 stars, silver. I could probably find a utility fund at Vanguard or at Schwab at 0.08, but I don't want all my eggs in that basket. $13 billion. There's a lot of money there. The yield is pretty good. And just so we can see what they're holding, they're pretty much like an index fund. So I don't expect any better return. Actually, a very slight return than the index because 0.10 is a fund expense, or if they have trading costs where they have to buy things. Now, utilities are down 5%, but I don't worry about that as much if I'm earning 3%. If it never recovers, I can get that back in a year and a half. And then in future years, I'm buying utilities and that Schwab and other dividend funds. I'm buying them for the yield to either buy cheaper shares when the market tanks and heal this thing back up. Or if I'm desperate and I say, look, my equities have dropped, but I'm not going to sell anything, I might have an average portfolio that earns, if I'm conservative, 3%. This fund is helping add to that, but it's down and I'm not going to sell it. So if you're going to draw your dividends only, they're not going to be a lot. But if you don't want to sell anything, the 3% a year is going to help us recover if we can reinvest the dividend. If we can't, then you draw the dividends and leave a lower value portfolio to your beneficiaries. Any questions so far? I'm going to go to Vanguard, and we've got Vanguard on the line. Hi, Vanguard. How are you? Tell me, what's going on? Well, they're a neutral rated fund, and that's because it's an index fund. So if it's an index fund, it follows the same allocation, the same recipe as whatever published index. And so whichever one this is, this index fund follows a specific recipe. They don't go out and buy and sell and do a lot of investment gymnastics. Their expense ratio is 0.07, and they're not doing a lot of buying and selling. So they're putting it out there. They're managing your inventory for you. Low expense ratio. Yield for this is 1.68, not because they're not doing a good job, but because they're looking for companies that have some growth potential and dividend appreciation, but that they're not paying out all of their earnings to the dividends. Something like an Amazon, when they start paying a dividend at some point, they have growth and dividend potential. So this is a good middle of the road fund for somebody that says, I want some growth potential, but I also want to keep the dividend reasonable and possibly growing. And they're looking for companies that are growing and paying bigger dividends because they're doing so well. So I would say overall, a dividend appreciation fund, you can get one at all the different companies, is a pretty good fund to buy because we're hoping it grows in value and the dividend keeps going. They're becoming more, see that? If any of you had a glass of wine or Hermosa, I don't drink, but don't worry, it's not you. That's what I have to put up with this software. I'm thinking I'm losing my mind. So let's go down if I can get to the bottom part and see what I have to go through every day. Okay. Holdings, dividend appreciation fund. So Microsoft obviously has future growth potential, but they have a dividend that is keeping up with the growth and growing. It's not going backwards. Again, I could look up a dividend exchange traded fund or a mutual fund that might be paying 5%. Yippee, it's better than these other guys. But they could be borrowing money to pay that 5%, or they could be just not reinvesting any cash to grow. They're just paying it all out in a dividend. That's okay if that's what I'm looking for. But in this particular case, I want companies that still have growth potential. So Johnson & Johnson, okay, some of you like it or dislike it. United Health, JP Morgan, Procter & Gamble, and so on. There are a variety of companies, 267, that have future growth potential of their dividend and hopefully in the share price. So this is a nice little area that instead of the S&P 500, although if you think they've hit a low point, I'd be looking at dividend appreciation funds if you don't need the full dividend or you don't need to liquidate, let's say within 5 to 10 years. If you're retired now and you don't have other sources of income, then you have to go back most likely and look at the volatility and the risk of the portfolio. And that makes us go into less risky things, but then we get less appreciation over the long term. Okay, so we've seen all these. There's several other Vanguard funds. Here's a high dividend fund. I think this would be similar to maybe that Schwab fund, and everybody has probably the same thing, 4 out of 5 stars, silver rating, 0.06, and almost a 3% yield. One reason to have this fund with a Vanguard and one with Fidelity, one with Schwab, is they might have different stocks in the portfolio. So that would be one thing. If they were the S&P 500, I might own different ones simply for hacking or some fear I have of the company running into trouble. But if it's a fund that they have some allocations that are different, I would own 2 or 3 different high dividend yield index funds simply so I have a different mix of assets. They can still seek the same thing, but I get a greater level of diversification. If I'm not worried about being in one place at the wrong time, then I don't diversify, but most of us are. So high dividend, high yield dividend. I don't know if I clicked on the right one, but yeah, I didn't. This is the one I meant to. Oh no, I didn't. International high dividend. Okay, crazy world. I haven't had anything to drink. 3.7 billion. Expense ratio higher, 0.20, because they're monitoring the index and it's international. But the yield is 4.30. I'm assuming they're dropping quite a lot recently. Not too bad as of yesterday. Well, as of recently, it's not even down. So this particular one, the assets that they hold look pretty good. But if I were buying, I might look for one from a reputable company that is down because these stocks held their own and are still fairly high priced. I might be wanting to buy another fund like it with Vanguard or somebody else where the price is lower right now. It might be a little late to buy into this, but you can see that the index went up more than this fund. So maybe they're being more conservative, but I'm not worried because international and the word, I think index in there tells me they're just buying one of everything for a low price. So they're not really, if this was a managed fund, I wouldn't be holding it. But if it's an index fund, there's a reason why the index went up more. It may be because Vanguard chooses to exclude some of the high risk positions that index might have had. So in our remaining time, let's take a look at what this portfolio looks like. You want to run your portfolios through a software similar to this so we know how we look. We're going to compare it to the New York Stock Exchange. So it's not a fair comparison completely. Let's see if I can get... I'll try this report again, see if I can drag it over. There we go. This is what this report created with all the funds that we saw. On the first page, you get the typical pie chart. In this particular one, 77%, 77.5% non-US, most everything's in stocks, 12% in cash and bonds. I hear a lot of talk shows where they say to a young person, you're 30 years old, everything should be in stocks in your 401k. I disagree. 80, 90% fine, because when the market tanks, all you have is next month's contribution. I'd like that young person to have money to move into the market when you get buying opportunity. Or if they got laid off or they had a break in service, they might have a couple months income they could liquidate. If they had to, there could be a penalty, but if they're disabled, there wouldn't be. They could get some money. So I don't know of any portfolios I would say somebody should have 100% stocks. Maybe a grandchild's portfolio that you're going to add to, that's fine, because you're going to buy into declining markets. But I like to have even a growth portfolio have some cash and bonds for emergency liquidations or emergency reallocations. Just saying, that's my opinion, and your opinion could be totally the opposite. And that's why if you manage and create the portfolios, follow your own heart, not somebody else's obsession to get in or out. If you have somebody do it for you, he or she should watch your body language and ask questions about how comfortable you are if this portfolio drops 10%, and then see how you react. 20%, 30%, and by then you're panicking. But they need to know that so they can reallocate the portfolio and bring the numbers down. So let's see what the numbers are for this portfolio. I'm going to skip down. Here's our chart. Compared to the New York Stock Exchange stock values, not reinvesting, they're in the blue area for the last 10 years. So the 10,000 grows up to this point. We're in the yellow line here, and we grew quite a bit more. Now, they're not reinvesting dividends. We are. So I think they'd probably be up with us at the same level. But to be fully disclosed and fair, we averaged in this growth portfolio about 12% a year. And the New York Stock Exchange benchmark only 7.83. But if they had any kind of dividends, they would have probably been closer to us. That's another point. These indexes where they tell you it's an index annuity and you're going to make money if the market goes up, well, you're not going to get dividends on the S&P 500 of which they're tracking. So if their call options make some money, you might make a little gain. They'll keep possibly half of it. I would stay away from annuities. If you have old ones, fine, hang on to them. But the new ones, be careful, because the company takes your money and they go out and invest it in their own portfolio in the way you should have in the first place. And then they take the first 1 or 2% yield and give you very little in return. I'm just saying, I'd be careful. This portfolio was down 19%, and from January to March 2020, the stock market dropped 38, but was down about 25. But this is a growth fund. It's going to be more volatile. We know that. This from left to right is volatility up and down. This is like a diving board, stairs, steps, stable part, getting out to the middle of the diving board, and it gets very volatile out here. Our portfolio's average volatility is about 10% on average, up or down. It's never the same every year, but that's the average. The stock market, in this case, the New York Stock Exchange, a little over 13. So we're almost 80% as volatile. So we got to be prepared for that. So standard deviation, historical ups and downs, 14% for the last 3 years, 18 on the benchmark, the stock market. 10 years, we were 10.5. The stock market was 13.5. We know that because we look at this thing called beta. If I can get any bigger here, beta tells us how similar of risk are we to the New York Stock Exchange. 80%, 79. Long-term, we're about 77% similar. So if the New York Stock Exchange drops 10% this year, we're expecting, no guarantees, but we're assuming we'll probably be down about 7.7 if all matches the beta risk. It won't. We'll be down more or less, but this gives us some idea of what to plan out for the future. So this portfolio is more for growth. Maybe it's one of your portfolios that you have invested for your adult children's retirement or maybe grandkids, but it is fairly volatile. Now, in the world of aggressive investing, then it would be very mild, but I say very volatile because most people that I know of are investing their nest egg for retirement. And we don't know if we're going to live 30 years or 30 days. We don't know that. We can't guarantee there isn't a bus around the corner, or that some unusual health genetic situation pops up. You and I know tons of people that were shocked that they're not alive today, and we're fortunately here today. But I can't tell you whether I'm going to live 30 days or 30 years. If I live 30 years, I've got to be invested for inflation. In 10 years, your cost of living will double. But I can't put everything out there because the market could tank on me. And obviously, if I only live 30 days, I guess I don't have too many financial problems, but we need to look at the whole perspective and be balanced. And that's a financial planning process. It's not just an investment process. Come to us, come to our front counter at our retail brokerage office. Sure, you can buy and sell stocks and exchange traded funds for no fee, but are they really helping you allocate everything in the total? Do you have long-term care insurance? Are you self-insured? Not a bad thing if you don't, but there's ways to plan these things. The old annuities could be your future long-term care, and so on. I have a client that's over 101 years old, very sharp lady. We plan differently for her. Now we're starting to enter into the equities because that money's starting to look like this is for the kids, and they're in their 50s or 60s. So the time horizon has changed a little bit. How am I doing? Moving too fast? Okay. So when we go down into beta, we saw that we're 0.77 because of all the funds we have mixed in here. They're that similar to the overall stock market. But here's a number that I get excited about. I can't sell you on this. That would be misrepresentation. But alpha, according to this report, you have positive an extra 5.27% rate of return compared to other portfolios that had the same risk or beta. Now, why is that? Well, we already started out buying super cheap funds. The universe of funds, there's some that have 1.5% expense ratio, 2%. So part of the reason we do a lot better is we shop super cheap funds. Then, of course, I hope we pick good managers of any funds we pay a higher fee for. So we're looking for quality of funds, whether it be low cost expense ratio or higher, but they do certain things to give us something in return. Because we all know that saying, what is it? Price is only an issue in the absence of value. So I'm willing to pay 0.85 for a manager to manage my preferred stocks that give us 5% a year, but are super interest rate sensitive. I'm willing to pay them a high fee to try to reduce the downside risk. We saw that they were down, I don't remember, 4.6 versus its index of 6% or something. So in my opinion, it's worth the extra fee, as long as you give me something in return. Because when the stock market dropped 65% March of 2009, and my managed fund has a different mix of stocks and it's down half that, now I'm loving a managed fund. I'm not saying that managed funds are the best place to be. They're at the top of the pyramid, the smallest allocation. You'll see that in the book, but they do have a place in the portfolio, in my opinion. So this portfolio has 77% of the risk, 5.27% per year better return than other portfolios like it. This is under Morningstar's portfolio report. I use the Morningstar Advisor station, but if you were super serious, go to Morningstar and see what they charge. Maybe for $150 a month, you can get a software that does this. I'm guessing. I think I pay close to $200 a month. If not, I used to say go to the library, but I don't see that libraries are out there holding this software. We're not big on the bonds in this portfolio, but these are the credit ratings, single B, double B, triple B and up. That's not a big thing for us. The duration we're not as worried about because we don't have as much money there. But the final thing here that we do want to know is, okay, Bill, you said how great those managed funds are with junk bonds and preferred stocks, but what's it going to do to our portfolio cost? Well, because we created the pyramid structure, the base being total market or broad market index funds that are cheap, our average expense ratio is 0.20. That's pretty good if you have a wide diversified portfolio. And I'll tell you quickly some of the benefits of a widely diversified portfolio. Not only do we have all these different companies and funds, but here, if you can see it, the equities, the stock blocks, small, medium, large, growth versus value. There's 5,230 stocks mixed among all the different funds. And so that helps us, one, bring the cost down, but increase the diversification. Only 2,125 bonds, but that's only because you have a small percentage. Many investors with a large percentage have 10 to 20,000 bonds. All this stuff may not mean much to many people, but I can see that I have a lot of equities or stocks, so be ready for a roller coaster ride. But I'm prepared because I have short-term intermediate positions. And as soon as the market drops, kind of like that automatic thing in the bathroom in the back of the bowl, when the water goes down, it turns on something and feeds it more water, right? We hear that leaving the restroom. A properly allocated portfolio is always going to have some cash and some conservative funds that when the market drops for the long-term stocks, you can move money over. Now, we're not in a huge correction yet. We could be. Then again, we might come right out of this. The things that are happening in Europe, it could get scary worse. Or maybe this tyrant is thrown out and we have a big kumbaya. I have no idea. The economists are very good at telling us what happened up until that point, but nobody can tell you how billions of people are going to react to news tomorrow. And the last research I found, there was over 100 million traders and buyers and sellers, you and I, and people that get online. I don't know. Obviously, right now, the market's down a fair amount. So those traders may be reacting to some negative news. If I go to the homepage, we may see more negative news. Yep. Still, value and blend are down quite a bit. We're down 664 as of the update here. I couldn't say what any one person should do. Is it a buying opportunity or should you hold back? That depends on your particular situation. So stepping back from this, I would highly recommend everybody review the workbook, Active Retirement Investing. It was created for you. And in future classes, even if we do this all over again, I'll have different versions of different things and when the economy works differently. I would stay away from the news, maybe look at it every couple of days. It's not going to help me watch the news, be more stressed out. That's not going to affect the markets. They're going to do what they're going to do. And you've already done a lot of planning. So I would say enjoy yourself as much as you can in life and step back. Hopefully you have a diversified portfolio among thousands of securities in the portfolio, among 5 to 15 different funds that do different things, and then among half as many different investment companies, cash in the bank, and do all the other things that you need to do. So next week, I think we mentioned in class 5, we'll be looking at page 156 to 178. And I hope this information allows you to take it on yourself or talk to a family member or partner and be a little more well-versed on what he or she's guiding you into. Or if you have an advisor, you can make sure that that person does what's right for you, because in the beginning of the book and at the back, we have a list of things that the advisor, if you hire one, should and shouldn't be doing, in my opinion. The days of commissions are in the past. We should be paying hourly, contractually, or a percentage of assets. And it should be fully transparent if you choose to hire somebody. And they shouldn't act like they're so smart and, oh, you wouldn't understand. You can if you have the time. That's the frustrating thing about technology now. I can't blame somebody else that I don't know how to fix this. I looked up problem with your mouse and it gave me all kinds of fixes. Now I got to go watch a YouTube video and figure out what to do. It's on us. It's on us. Read the book, decide what you want to do, but be empowered a little bit more so you don't make mistakes or you can't be taken advantage of. So I'm hunterwilliambailey.com. Look forward to seeing you next time. And I hope you have a chance to look at the book, and everyone be well, as they say. And I'm going to come out of here if I can figure out how to do it, and I'll see you next week.